As Europe grapples with an intensifying economic downturn, the US may soon face similar challenges. This time, however, there's a significant difference. China, once a potential economic savior, is not stepping in to offer help. What does this mean for the world economy, and how might it impact your financial future? Europe is facing a severe economic crisis, exacerbated by soaring energy prices and the financial burden of supporting the ongoing conflict in Ukraine. Despite China's recent efforts to stabilize its own economy, the European Union seems unable to bounce back. The latest decisions by the European Central Bank, ECB, paint a worrying picture. The ECB has lowered interest rates for the third time this year, reducing the deposit rate from 3.5% to 3.25%. While this move might suggest that inflation is under control, it could also signal a desperate attempt to keep the economy from sinking further. Within days of the rate cut, the value of the euro fell by nearly 1% against the US dollar, driving up the cost of imports, especially energy. This devaluation intensifies the challenges faced by European households and businesses as rising costs further squeeze living standards. The ECB's strategy may offer short-term relief, but it doesn't tackle deeper systemic problems like energy dependence and geopolitical uncertainty. Christine Lagarde, president of the ECB, has issued stark warnings reminiscent of the fears that preceded the Great Depression of the 1920s. The ECB is attempting to stave off a full-blown economic collapse by deploying every available monetary tool. However, her statements suggest that further interest rate cuts may be on the horizon, indicating that the financial outlook remains precarious. Europe's reliance on financial engineering to address industrial and geopolitical challenges is a temporary fix at best. The region's structural weaknesses, such as high energy dependency, sluggish productivity, and escalating geopolitical tensions, continue to obstruct any meaningful recovery. Germany, Europe's largest economy, is on the brink of recession, with growth forecasts remaining grim, projecting a mere 0.3% annual growth through 2026. The cost of energy, particularly liquefied natural gas imports from the United States and Qatar, is a significant drain on Europe's finances. The continent's shift away from affordable Russian gas has made energy costs unsustainably high, further deepening the economic crisis. Moreover, the debt accumulated from subsidizing energy costs has reduced investment in critical sectors, such as electric vehicles and green energy, undermining Europe's long-term growth potential. Morgan Stanley suggests that the ECB may continue to lower interest rates, possibly bringing them down to 1.75% by next year. However, given the ongoing geopolitical tensions, such as the war in Ukraine, instability in the Middle East, and unpredictable oil markets, such a move could prove to be a double-edged sword. Lowering rates without addressing the underlying issues is akin to putting a band-aid on a wound that requires surgery. Europe's economic decline is particularly concerning given its share of global GDP, which stands at approximately 17.7%. Unless Europe can secure affordable energy and implement significant structural reforms, its global competitiveness will continue to decline. Diminished former ECB President Mario Draghi has repeatedly warned about the burden of high energy costs on Europe's industrial sector. In 2023, the cost of electricity for industry in Europe soared above $170 per megawatt hour, far higher than in China or the US. Gas prices are similarly 3 times more expensive than those in the US, pushing industries to the brink of collapse. Despite pouring over $650 billion into subsidizing energy costs for both industries and consumers, the EU has financed this aid through substantial borrowing, adding to its mounting debt. Countries like France are running deficits that exceed 6% of GDP, similar to the fiscal policies of the United States, but without the luxury of the dollar's reserve currency status. This mounting debt burden is increasingly limiting the EU's fiscal flexibility and raising the risk of a sovereign debt crisis in weaker economies. The ongoing energy crisis highlights a harsh reality. Without access to affordable energy, Europe's industries cannot compete on a global scale. As energy costs rise and industries shudder, Europe faces an uncertain future with few solutions on the horizon. As the EU struggles to find its footing, the question remains, will Europe manage to overcome these structural challenges, or will its economic decline have far-reaching consequences for the global economy? The future is uncertain, but one thing is clear. China, once seen as a potential savior, will not be stepping in to provide the support Europe desperately needs. Europe's economic competitiveness is closely tied to the rising costs of energy. While the United States ramps up domestic oil production, and China aggressively pursues cost-effective solar and nuclear solutions, Europe finds itself dependent on expensive imports. Simply adjusting financial policies will not be enough to close the gap caused by soaring energy prices, which continue to suppress productivity in key industries like chemicals, metals, and plastics. This slowdown in industrial output has had widespread effects, weakening the economies of vital EU members such as Germany, France, and Italy. In turn, these economic struggles are contributing to higher unemployment rates and falling living standards across the continent. One potential, though controversial, solution to Europe's energy dilemma could involve rekindling ties with Russia to resume gas imports. Before geopolitical tensions escalated, Russian gas through the Nord Stream pipelines enabled Europe to maintain competitive energy costs. While Europe is pushing forward with renewable energy initiatives like solar and nuclear, these technologies require significant time and investment to scale up. In the short term, bringing in Russian gas might offer the quickest route to restoring industrial strength. This is a choice European leaders might eventually have to make if they want to regain their footing in global markets. Meanwhile, China is focusing on boosting its own economy with a hefty stimulus package aimed at stimulating consumer demand and stabilizing its real estate market. However, Europe is unlikely to benefit from this strategy. A key element of China's approach involves increasing bank lending by nearly $600 billion to support its struggling property sector, a move that prioritizes domestic stability over international trade. Additionally, China is working to address its growing local government debt by injecting liquidity into banks and cutting interest rates. Beijing's primary focus is on domestic issues rather than assisting Europe with its economic crisis. As tensions between China and the West escalate, Europe's trade relationship with China has suffered. Chinese exports to the EU dropped from 2022 to 2023, and European imports to China saw a similar decline. Beijing's push to strengthen its domestic industries means future stimulus will likely prioritize China's internal growth over international economic exchanges, exacerbating Europe's struggle to recover. This growing divergence reflects a broader trend of countries becoming more self-reliant and less dependent on foreign markets, further complicating Europe's path forward. The EU's automotive industry, for example, is under severe pressure. Competing with Chinese companies, particularly those producing electric vehicles at a fraction of the cost, has become nearly impossible. German car makers like Volkswagen and Mercedes have seen their market share in China shrink significantly. With high production costs and widespread energy inefficiencies, financial relief alone won't counter these challenges. Beyond energy costs, Europe's regulatory environment poses a significant barrier to economic growth. Many view European regulations as overly burdensome, creating obstacles for businesses and stifling innovation. Simplifying these regulatory processes and creating a more business-friendly environment could foster economic revitalization and attract investment. The current economic trajectory in Europe is deeply concerning. Rising energy prices, deindustrialization, geopolitical tensions, and increasing debt are converging to create a perfect storm. Europe's failure to secure affordable energy, combined with an over-reliance on financial measures without addressing underlying structural issues, leaves it vulnerable to future economic shocks. To stabilize and grow, Europe must undertake significant reforms, including ensuring energy security, overhauling regulatory systems, and revitalizing its industrial base. European leaders must acknowledge that quick financial fixes will not resolve the deep-rooted problems. Only comprehensive, far-reaching reforms can help Europe emerge from this crisis stronger and more competitive. The situation in Europe highlights the interconnectedness of the global economy. The EU's energy crisis and industrial decline could affect other economies, including the United States. As China focuses on its own priorities, the question arises: how can Europe and the US navigate these turbulent times without relying on external support?